Question 1. Which of the following best describes the role of a captive insurance manager in a Massachusetts-based captive insurance company? A. They are responsible for underwriting all policies directly within the captive. B. They handle the daily operations of the captive, including managing claims and ensuring compliance with regulatory requirements. C. They are only responsible for marketing the captive's policies to external clients. D. They solely focus on investments and are not involved in operational matters. Answer. B. They handle the daily operations of the captive, including managing claims and ensuring compliance with regulatory requirements. Explanation. Captive insurance managers in Massachusetts are integral to the daily operations of the captive insurance company. Their duties include managing claims, overseeing compliance with Massachusetts Division of Insurance (DOI) regulations, coordinating financial reporting, and ensuring the solvency of the captive. They are not merely marketers or investors, but are key to ensuring the efficient and legal operation of the captive under Massachusetts law. The role requires extensive knowledge of financial management, risk retention, and regulatory requirements as outlined in the Massachusetts General Laws, Chapter 175. Question 2. A Massachusetts-based captive insurance company offers workers' compensation coverage to its parent company. The captive uses a third-party actuary to assess the claims reserves. Which of the following is the most important consideration for ensuring the financial solvency of the captive? A. Setting a high premium to increase the amount of capital held. B. Ensuring that the reserves are adequate based on the actuarial assessment of future claims. C. Reducing administrative expenses as much as possible. D. Limiting the investment portfolio to only high-risk, high-return assets. Answer. B. Ensuring that the reserves are adequate based on the actuarial assessment of future claims. Explanation. In captive insurance, especially for workers' compensation, ensuring that reserves are adequate to cover future claims is critical for maintaining financial solvency. This requires actuarial assessments that predict the future costs of claims based on historical data and other relevant factors. According to Massachusetts regulations, captives must maintain adequate reserves as part of their risk-based capital (RBC) requirements. Option whistle setting. A high premium is not a reliable method for ensuring solvency, and options C and D focus on other areas that do not directly address the solvency requirements. Question 3. Scenario-based. Mr. Tanner is the CEO of a manufacturing company that is considering forming a captive insurance company in Massachusetts to self-insure some of its risks, including property damage and liability. He contacts an insurance consultant to explore the feasibility of forming a single-parent captive. Which of the following actions should Mr. Tanner take first in the process of forming the captive? A. Submit an application to the Massachusetts Division of Insurance (DOI) for a captive license. B. Conduct a feasibility study to determine if forming a captive insurance company is financially viable. C. Begin writing insurance policies immediately to cover the company's risks. D. Immediately hire a captive insurance manager without further consultation. Answer. B. Conduct a feasibility study to determine if forming a captive insurance company is financially viable. Explanation. Before forming a captive insurance company in Massachusetts, Mr. Tanner should conduct a feasibility study. This study is essential to assess the financial viability of the captive and evaluate whether the company can meet its insurance and regulatory requirements. This study will also inform decisions about the appropriate structure for the captive. G. Single-parent captive, required capitalization, and long-term sustainability. The Massachusetts Division of Insurance (DOI) requires that captives submit a business plan that includes this analysis. Simply applying for a license or beginning operations without completing this study would be premature and non-compliant with regulatory standards. Question 4. A Massachusetts-based captive insurance company is considering a rent-a-captive arrangement to write workers' compensation insurance for several small businesses. Which of the following is a key advantage of a rent-a-captive structure? A. It allows small businesses to share in the risk and rewards of underwriting their own policies. B. It requires that the businesses fully own and operate the captive insurance company. C. It provides a low-cost, low-regulation method for businesses to self-insure. D. Allows businesses to avoid regulatory requirements altogether by operating outside of Massachusetts. Answer A. It allows small businesses to share in the risk and rewards of underwriting their own policies. Explanation: a rent-a-captive allows businesses, typically small to medium-sized, to use the infrastructure of an existing captive insurance company to write their own policies. This allows businesses to share in the underwriting risks and rewards without the financial burden and administrative responsibilities of forming and operating their own captive. It does not fully eliminate regulatory oversight, as the Massachusetts Division of Insurance (DOI) will still require regulatory compliance. Unlike fully owned captives, businesses do not need to form their own companies, but instead rent space within an established entity. Question 5. In a Massachusetts-based captive insurance company, which of the following would be a prohibited practice under Massachusetts General Laws, MGL, Chapter 175? A. Writing insurance policies for risks that are unrelated to the business activities of the parent company. B. Charging premiums based on the actual risk exposure of the insured party. C. Using surplus funds to invest in low-risk government bonds. D. Maintaining a separate claims reserve for each line of insurance coverage. Answer: A. Writing insurance policies for risks that are unrelated to the business activities of the parent company. Explanation: Massachusetts law MGL Chapter 175 requires that captives write insurance for risks that are related to the business activities of the parent company. Captive insurance is designed to address risks that the parent company faces, and writing unrelated insurance policies would violate the purpose of the captive structure. Charging premiums based on actual risk exposure, option B, and using surplus funds for low-risk investments, option C, are permissible as long as they align with regulatory standards. Maintaining separate reserves for each line of coverage is a sound financial practice, option D. Question 6. A Massachusetts-based captive insurance company is considering offering directors and officers DO liability coverage. Which of the following is a key consideration in providing DO coverage through a captive? A. Ensuring that the coverage is in compliance with the Massachusetts Division of Insurance regulations regarding policy limits. B. Providing unlimited coverage limits to attract more directors to the company. C. Offering DO coverage only for external directors and officers of the parent company. D. Using the captive to limit the financial liabilities of the directors and officers without any reporting requirements. Answer: A. Ensuring that the coverage is in compliance with the Massachusetts Division of Insurance regulations regarding policy limits. Explanation: when offering directors and officers DO liability coverage through a Massachusetts-based captive, it is crucial to ensure that the policy complies with Massachusetts Division of Insurance regulations. These regulations govern aspects such as policy limits, types of coverage, and disclosures. DO policies must be carefully structured to balance adequate coverage for directors and officers with the regulatory requirements set by the DOI. Offering unlimited coverage, option B, may not be appropriate as it could violate regulatory restrictions on policy limits. Option C is incorrect as the coverage typically extends to both internal and external directors or officers of the company. Option D is also wrong because there are stringent reporting and regulatory requirements for DO coverage. Question 7. Which of the following financial management practices is required for a Massachusetts-based captive insurance company to ensure solvency under Massachusetts regulations? A. Maintaining a solvency margin of 10% above the risk-based capital (RBC) requirement. B. Investing primarily in equities to achieve high returns for the captive's assets. C. Establishing and maintaining reserves based on actuarial guidance for expected claims and losses. D. Limiting premium income to avoid exceeding regulatory limits set by the Massachusetts Division of Insurance. Answer: C. Establishing and maintaining reserves based on actuarial guidance for expected claims and losses. Explanation: Massachusetts regulations require that captive insurance companies maintain adequate reserves for future claims and losses. This is typically determined through actuarial guidance that estimates the potential future liabilities of the captive. Reserving based on actuarial analysis ensures that the company can meet its obligations and remain solvent. Option is incorrect because the solvency requirements are based on the RBC framework, but there is no specific requirement to maintain a 10% margin above RBC. Option B is also wrong because captives are generally required to follow investment policies that align with their risk profiles, and they are not allowed to take excessive investment risks, such as focusing primarily on equities. Option D is incorrect as the regulatory limits focus on solvency and capitalization rather than limiting premium income. Question 8. A Massachusetts-based captive insurance company needs to comply with annual financial reporting requirements. Which of the following statements best describes the necessary components of this report? A. The annual report must include a detailed actuarial report, a balance sheet, and a statement of cash flows, but not an income statement. B. The report must be submitted only if the captive is financially struggling. C. The report must include an income statement, a balance sheet, a statement of cash flows, and an actuarial analysis of claims reserves. D. The report does not need to include a statement of cash flows as it is not required by Massachusetts regulations. Answer: C. The report must include an income statement, a balance sheet, a statement of cash flows, and an actuarial analysis of claims reserves. Explanation: Massachusetts regulations require captives to submit a comprehensive annual financial report that includes an income statement, a balance sheet, a statement of cash flows, and an actuarial analysis of claims reserves. These components provide a full picture of the financial health of the captive, ensuring it is solvent and capable of meeting its future obligations. Option A is incorrect because the income statement is also required. Option B is incorrect because annual reporting is mandatory for all captives, not just those facing financial difficulties. Option D is incorrect because a statement of cash flows is required under Massachusetts financial reporting regulations. Question 9. A Massachusetts-based captive insurance company is assessing its financial stability in compliance with solvency regulations. Which of the following is a key metric used to evaluate the solvency of a captive insurer? A. The net income of the captive for the year. B. The risk-based capita RBC ratio. C. The total premium income of the captive. D. The total amount of claims paid during the year. Answer: B. The risk-based capital RBC ratio. Explanation: the risk-based capita (RBC) ratio is the key metric used to evaluate the solvency of a captive insurer under Massachusetts regulations. This ratio assesses the adequacy of the captive's capital in relation to its risks, ensuring that it can cover its liabilities in adverse situations. Optional net income is not directly related to solvency, though it can impact the overall financial health. Option C, total premium income, and Option D, total claims paid, are important for understanding a captive's operations but are not used specifically to evaluate solvency. The RBC ratio directly measures the financial resilience of the captive against its risk exposure. Question 10. A Massachusetts captive insurance company is considering expanding its coverage to include environmental liability. Which of the following is a primary regulatory consideration for expanding its coverage? A. The company must obtain approval from the Massachusetts Division of Insurance to write environmental liability coverage. B. The company can write environmental liability coverage without any additional regulatory approval. C. The company must lower its premium rates for environmental liability coverage to be competitive. D. The company can only write environmental liability coverage if it is part of a group captive arrangement. Answer: A. The company must obtain approval from the Massachusetts Division of Insurance to write environmental liability coverage. Explanation: in Massachusetts, captives must obtain approval from the Massachusetts Division of Insurance (DOI) before expanding their coverage to include new lines, such as environmental liability. This ensures that the captive is adequately prepared to handle the risks associated with the new coverage and complies with regulatory requirements. Option B is incorrect because new lines of business require regulatory approval. Option C, lowering premium rates, is not a regulatory requirement, and Option D is incorrect because environmental liability can be written in both single-parent and group captives, not exclusively in group arrangements. Question 11. A Massachusetts-based captive insurance company plans to diversify its investment portfolio. Which of the following investment strategies would most likely help the captive maintain financial stability while complying with Massachusetts regulations? A. Investing heavily in high-risk, speculative stocks to maximize returns. B. Maintaining a conservative investment strategy focused on bonds, real estate, and other low-risk assets. C. Diversifying into international markets without any restrictions on the types of investments. D. Focusing exclusively on short-term investments to maintain liquidity at all costs. Answer: B. Maintaining a conservative investment strategy focused on bonds, real estate, and other low-risk assets. Explanation: Massachusetts regulations encourage captives to adopt prudent investment strategies that prioritize financial stability and solvency. A conservative approach with investments in low-risk assets like bonds and real estate is typically recommended to ensure that the captive has the financial resources to meet its obligations. High-risk investments, Option A, or unrestricted international investments, option C, are not in line with regulatory guidance for maintaining financial stability while maintaining liquidity. Option D is important. A balance with long-term investment growth is typically required for the solvency of the captive. Question 12. A Massachusetts-based captive insurance company needs to comply with minimum capital requirements. What is the general minimum capital requirement for a captive insurer under Massachusetts law? A. $500,000. B. $1 million. C. $2,500,000. D. $5 million. Answer: B. $1 million. Explanation: under Massachusetts regulations, a captive insurance company must maintain a minimum capital requirement of $1 million. This ensures that the company has adequate resources to handle its liabilities and support its financial stability. While this amount is subject to change based on the type and size of the captive, $1 million is generally the minimum capital requirement under Massachusetts law. Question 13. A Massachusetts-based captive insurance company is considering writing health insurance policies for its parent company's employees. Which of the following is a key regulatory requirement for offering health insurance through a captive? A. The company must obtain approval from the Massachusetts Division of Insurance for the specific type of health coverage being written. B. Health insurance policies cannot be written by any captive insurance company in Massachusetts. C. The company must provide health insurance coverage for all employees of the parent company. D. The company must demonstrate that health insurance is the primary line of business for the captive. Answer A. The company must obtain approval from the Massachusetts Division of Insurance for the specific type of health coverage being written. Explanation: before offering health insurance, a Massachusetts-based captive must obtain approval from the Massachusetts Division of Insurance for the specific health coverage line. This is necessary to ensure compliance with both regulatory and actuarial standards. Captives can offer health insurance, but they must follow state regulations and obtain approval before doing so. Option B is incorrect, as captives are allowed to write health insurance under the right circumstances. Options C and D are not correct because the law does not require captives to cover all employees or make health insurance the primary line of business. Question 14. Which of the following is a key benefit of a Massachusetts-based captive insurance company in terms of tax treatment? A. Captive insurance premiums are fully exempt from Massachusetts income tax. B. Premiums paid to a captive insurance company may be deductible for the parent company subject to certain conditions. C. Captives are completely exempt from state and federal taxes on their investment income. D. Captives are subject to a fixed tax rate of 5% on all premiums earned. Answer: B. Premiums paid to a captive insurance company may be deductible for the parent company subject to certain conditions. Explanation: in Massachusetts, premiums paid to a captive insurance company by its parent company may be deductible for tax purposes provided that the premiums are considered to be reasonable and based on actuarial guidance. This can provide tax advantages to the parent company. However, captives are subject to taxes on investment income and must comply with various tax regulations. Option is incorrect because premiums are not exempt from income tax. Option C is incorrect because captives are still subject to taxes on their investment income. Option D is incorrect as there is no fixed 5% tax on all premiums. Question 15. Under Massachusetts law, a captive insurance company must submit its annual financial statement to which of the following authorities? A. The Internal Revenue Service (IRS). B. The Massachusetts Division of Insurance (DOI). C. The U.S. Securities and Exchange Commission (SEC). D. The National Association of Insurance Commissioners (NAIC). Answer: B. The Massachusetts Division of Insurance (DOI). Explanation: captive insurance companies in Massachusetts are required to submit their annual financial statement to the Massachusetts Division of Insurance (DOI), which is the state regulator responsible for overseeing captive insurance operations. While the IRS, SEC, and NAIC may be involved in some aspects of regulatory oversight, the DOI is the primary body for captive-related filings in Massachusetts. Question 16. A Massachusetts-based captive insurance company is considering entering the reinsurance market. Which of the following is a critical regulatory consideration for a captive when assuming reinsurance risks? A. The captive must maintain a separate license to operate as a reinsurer in Massachusetts. B. Reinsurance premiums are fully exempt from all state regulations in Massachusetts. C. The captive must comply with additional capital and surplus requirements for writing reinsurance. D. Reinsurance can only be written for risks outside of Massachusetts. Answer: C. The captive must comply with additional capital and surplus requirements for writing reinsurance. Explanation: captive insurance companies in Massachusetts that enter the reinsurance market must meet additional capital and surplus requirements to ensure they can handle the increased risks associated with assuming reinsurance business. This is part of the regulatory framework to maintain solvency and protect policyholders. Option is incorrect because a separate license is not always required for reinsurance operations within the same captive structure. Option B is incorrect because reinsurance premiums are still subject to regulatory oversight. Option D is incorrect as reinsurance can be written both inside and outside of Massachusetts provided the captive meets the regulatory standards. Question 17. A Massachusetts-based captive insurance company is considering increasing its retained risk exposure. Which of the following is a regulatory requirement for captives seeking to retain higher risk levels? The captive must secure reinsurance for all retained risks exceeding a certain threshold. B. The captive must demonstrate adequate reserves and surplus to support the increased risk exposure. C. The captive must submit a detailed risk management plan to the National Association of Insurance Commissioners. D. The captive must obtain prior approval from the Massachusetts Division of Insurance to retain additional risk. Answer: B. The captive must demonstrate adequate reserves and surplus to support the increased risk exposure. Explanation: captives seeking to retain higher levels of risk must ensure that they have sufficient reserves and surplus to cover the additional exposure. Massachusetts regulations require captives to demonstrate their financial stability and ability to handle the increased risk without compromising solvency. Option is incorrect because reinsurance is not always mandatory for higher retained risks. Option C is incorrect as the NAIC does not require submission of a risk management plan for this purpose. Option D is incorrect because prior approval from the Massachusetts DOI is not required solely for increasing retained risk levels as long as the financial stability of the captive is maintained. Question 18 weighs the purpose of the capital and surplus requirements for Massachusetts-based captive insurance companies. A. To ensure that captives can pay dividends to their parent companies. B. To provide a buffer to cover future claims and maintain solvency. C. To limit the amount of premiums a captive can write. D. To guarantee a fixed profit margin for the captive insurer. Answer: B. To provide a buffer to cover future claims and maintain solvency. Explanation: the capital and surplus requirements for Massachusetts-based captive insurance companies are designed to ensure that the captive has sufficient financial resources to meet future claims and remain solvent. These reserves act as a buffer against unexpected losses. Option A is incorrect because capital and surplus are not intended for paying dividends. Option C is incorrect because capital and surplus requirements do not limit premium writing but ensure financial stability. Option D is incorrect because the purpose is not to guarantee a fixed profit but to maintain the solvency of the captive. Question 19. A Massachusetts-based captive insurance company is seeking to issue policies that cover risks related to cyber liability. Which of the following is a regulatory consideration for offering cyber liability coverage? A. The Massachusetts Division of Insurance does not regulate cyber liability policies. B. The captive must obtain approval from the Massachusetts Division of Insurance before writing cyber liability coverage. C. The captive can write cyber liability policies without any specific approval if the coverage is related to data breaches. D. Cyber liability coverage can only be offered by captives that are part of a group insurance structure. Answer: B. The captive must obtain approval from the Massachusetts Division of Insurance before writing cyber liability coverage. Explanation: the Massachusetts Division of Insurance requires approval for captives offering new lines of business, including cyber liability coverage. This ensures that the captive has the appropriate reserves, underwriting guidelines, and risk management practices in place to handle such policies. Option A is incorrect because cyber liability is subject to regulatory oversight. Option C is incorrect because approval is still required for all new coverage lines. Option D is incorrect because cyber liability can be offered by both single parent and group captives. Question 20. Which of the following best describes the requirements for a Massachusetts-based captive insurance company to write policies for its parent company? A. The captive must demonstrate that it is financially independent from its parent company. B. The captive must primarily insure risks directly related to the parent company or its affiliates. C. The captive must offer policies to at least 3 unrelated third parties in addition to its parent company. D. The captive must obtain reinsurance for all policies written for the parent company. Answer: B. The captive must primarily insure risks directly related to the parent company or its affiliates. Explanation: under Massachusetts regulations, captive insurance companies are typically established to insure risks of their parent companies or affiliated entities. The primary purpose of the captive is to provide tailored risk management solutions for the parent organization, rather than serving as a commercial insurer for unrelated parties. Option A is incorrect because captives are often wholly owned by the parent and are not required to be financially independent. Option C is incorrect because captives are not required to insure unrelated third parties. Option D is incorrect because reinsurance is not mandatory for all policies written for the parent. Question 21. Which of the following accurately describes the financial solvency requirements for a Massachusetts captive insurance company? A. A captive must maintain a minimum capital and surplus of $250,000 or higher as determined by its business plan. B. Captives are required to maintain reserves equal to 100% of their total policy limits. C. Captives in Massachusetts are exempt from statutory capital and surplus requirements. D. A captive solvency requirements are only assessed at the time of initial licensing. Answer A. A captive must maintain a minimum capital and surplus of $250,000 or higher as determined by its business plan. Explanation: Massachusetts captive insurance law requires captives to maintain minimum capital and surplus levels, typically set at $250,000 or as specified during the regulatory approval process based on the risks undertaken. Option B is incorrect because reserves are based on actuarial assessments and not an arbitrary percentage of policy limits. Option C is incorrect as statutory capital and surplus requirements apply to ensure financial solvency. Option D is incorrect because captives are subject to ongoing solvency assessments and examinations. Question 22. Under Massachusetts law, which of the following would be considered a prohibited practice for a captive insurance company? A. Insuring risks associated with its parent company. B. Offering reinsurance to an unrelated insurer. C. Failing to file annual financial statements with the Division of Insurance. D. Accepting premiums paid in non-U.S. currency. Answer: C. Failing to file annual financial statements with the Division of Insurance. Explanation: captives are required to submit annual financial reports to the Massachusetts Division of Insurance to demonstrate compliance with regulatory standards. Option A and B are permitted activities within the scope of a captive's operations. Option D is incorrect because Massachusetts does not explicitly prohibit the acceptance of premiums in non-U.S. currency as long as it is accounted for properly and complies with applicable regulations. Question 23, scenario-based. Mr. Jacobs, CFO of a Massachusetts-based manufacturing company, is exploring the use of a captive to insure the company's property risks. The company plans to form a single parent captive. However, during discussions, it is suggested that the captive also underwrite third-party risks for suppliers and contractors. What regulatory consideration must Mr. Jacobs address before proceeding? A. Ensure the captive files a modified business plan and seeks approval from the Division of Insurance. B. Confirm that third-party risks are capped at 10% of the captive's total annual premiums. C. Verify that the captive will comply with international reinsurance regulations. D. Obtain a separate captive license specifically for third-party underwriting activities. Answer A. Ensure the captive files a modified business plan and seeks approval from the Division of Insurance. Explanation: if a Massachusetts-based captive intends to underwrite third-party risks, it must notify the Division of Insurance, amend its business plan, and obtain approval. This ensures that the additional risks align with the regulatory framework and solvency requirements. Option B is incorrect because there is no specific cap of 10% for third-party premiums. Requirements depend on the business plan and solvency. Option C is unrelated to the captive's primary regulatory obligations. Option D is incorrect as Massachusetts law does not require a separate license for third-party underwriting but does require regulatory oversight. Question 24. Which statement best describes the taxation of Massachusetts captives? A. Captives are exempt from all state taxation provided they are domiciled in Massachusetts. B. Captives are subject to a premium tax based on direct premiums written but not reinsurance premiums assumed. C. Captives must pay corporate income tax on all income derived from premiums and investments. D. Captives domiciled in Massachusetts are taxed solely at the federal level under IRS regulations. Answer: B. Captives are subject to a premium tax based on direct premiums written but not reinsurance premiums assumed. Explanation: Massachusetts imposes a premium tax on direct premiums written by captives, excluding premiums assumed through reinsurance. Option A is incorrect because captives are not exempt from all state taxes. Option C is incorrect because captives are not taxed on investment income at the state level. The federal regulations address this separately. Option D is incorrect because state taxation applies in addition to federal oversight. Question 25. What is the primary role of a captive manager under Massachusetts regulations? A. Act as the primary reinsurer for the captive's risks. B. Conduct independent audits of the captive's financial statements. C. Manage the day-to-day operations, including compliance and reporting. D. Represent the captive during litigation and dispute resolution. Answer: C. Manage the day-to-day operations, including compliance and reporting. Explanation: A captive manager oversees the captive's daily operations, ensuring compliance with Massachusetts regulations, proper risk management, and timely financial reporting. Option A is incorrect because captive managers do not act as reinsurers. Option B is incorrect because independent audits are typically performed by external auditors. Option D is incorrect as legal representation during disputes is generally handled by attorneys. Question 26. In Massachusetts, what is the statutory accounting principle SAP most relevant to captives? A. Fair value accounting for all investment portfolios. B. Recognizing premium revenue when policies are issued regardless of payment status. C. Maintaining adequate loss reserves for claims liabilities. D. Allocating all surplus funds exclusively for dividend distribution. Answer: C. Maintaining adequate loss reserves for claims liabilities. Explanation: Massachusetts captives must adhere to statutory accounting principles, emphasizing sufficient reserves to cover potential claims liabilities. Option A is incorrect as SAP typically focuses on conservatism rather than fair value accounting. Option B is not aligned with SAP's focus on realized transactions. Option D is incorrect because surplus allocation must prioritize solvency, not dividend distribution. Question 27. How can Massachusetts-based captives manage cybersecurity risks effectively? A. Conduct annual penetration testing and report the results to the Division of Insurance. B. Implement a comprehensive cybersecurity program aligned with state regulations. C. Outsource all cybersecurity responsibilities to third-party vendors. D. Require all policyholders to purchase standalone cyber insurance policies. Answer: B. Implement a comprehensive cybersecurity program aligned with state regulations. Explanation: Massachusetts regulations encourage captives to establish robust cybersecurity programs to protect sensitive data and operations. Option A is incorrect because penetration testing is part of broader cybersecurity measures but is not required annually. Option C is incorrect as outsourcing does not absolve the captive from regulatory responsibility. Option D is unrelated to the captive's role in managing its own cybersecurity risks. Question 28, scenario-based. MS. Patel manages a captive that covers medical malpractice risks for affiliated hospitals. A dispute arises regarding a denied claim involving significant legal costs. What would be the most appropriate first step under Massachusetts law? A. Initiate litigation against the claimant to clarify legal obligations. B. Seek mediation or arbitration as specified in the policy terms. C. File a complaint with the Division of Insurance for resolution. D. Negotiate a reinsurance settlement to fund the denied claim. Answer: B. Seek mediation or arbitration as specified in the policy terms. Explanation: Massachusetts emphasizes alternative dispute resolution mechanisms such as mediation or arbitration, especially for captives managing complex claims. Option is premature, as litigation should be a last resort. Option C is inappropriate unless regulatory intervention is warranted. Option D is unrelated to resolving the dispute directly with the claimant. Question 29. Which of the following is a key feature of a protected cell captive? A. Cells are not legally distinct from the core captive. B. Each cell has its own financial and legal identity. C. Protected cell captives cannot insure unrelated third-party risks. D. A core captive can access the assets of its cells without restrictions. Answer: B. Each cell has its own financial and legal identity. Explanation: Protected cell captives maintain separate financial and legal identities for each cell, safeguarding assets and liabilities. Option A is incorrect because cells are distinct entities. Option C is incorrect, as protected cell captives can ensure third-party risk subject to regulatory approval. Option D is incorrect because asset access between cells and the core is restricted by law. Question 30. What is the primary purpose of a Massachusetts captives feasibility study? A. To confirm compliance with international insurance standards. B. To assess the financial viability and operational plan of the captive. C. To obtain a pre-approval certificate from the Division of Insurance. D. To determine the reinsurance market's interest in the captive. Answer. B. To assess the financial viability and operational plan of the captive. Explanation. A feasibility study evaluates whether forming a captive is financially and operationally sound. Option A is incorrect, as compliance with international standards is not the primary focus. Option C is incorrect, as pre-approval is not part of the feasibility study. Option D is unrelated, as the feasibility study focuses on internal viability rather than external interest.